This week gave us way more than just two insane headlines, but there were two that collided specifically inside the bond market. Just hours after I published this vlog last Friday, talking about the impacts of President Trump's announcement that government entities should purchase $200 billion in mortgage-backed securities in order to lower mortgage interest rates. Just hours after that, the Federal Reserve was served a flurry of subpoenas. This man, Donald Trump, is his own worst enemy because mortgage bonds did not like the news of this investigation and interest rates reacted poorly. Nevertheless, we saw a surge of buyer activity over the weekend and into this week, which, when you consider what's going on in the world right now, the fact that people want to buy a house seems actually insane. But I have a theory about why all of these folks are finally jumping off the fence and into action, and it's probably going to surprise you. A criminal investigation was launched by the Department of Justice Friday evening into the Federal Reserve Chair, Jerome Powell. It's particularly important to understand this investigation is specifically into whether he gave misinformation in a testimony before Congress about a renovation of the Federal Reserve's headquarters. Not Fed policy, not rate cuts. Please note, Powell isn't the auditor of the budget for this renovation. There is an independent office of the Inspector General that audits project costs, contracts, and that they're all in compliance. The budget for the renovation for these buildings has increased to $2.5 billion. That's already a really big number, and it's being made even bigger in some places by certain sources. The Fed's power, though, comes from perceived independence. Any suggestion that monetary policy could be influenced or pressured, that injects uncertainty into the markets, which bonds and in turn mortgage interest rates don't react favorably to. This whole juxtaposition of Trump's announcement and then the subsequent launch of the investigation really illustrates how fragile any downward momentum in interest rates is right now, because we immediately gave back some of the gains we had seen on Thursday and Friday once the news of the investigation broke. Let me cut through the noise here, because I'm not sure I'm being truly clear. The investigation into Jerome Powell is not about interest rate policy, not about quantitative easing, or some secret misuse of Fed power. It's narrowly focused on whether his congressional testimony about a building renovation project accurately reflected the projected costs at that time. That's it. The Federal Reserve is renovating aging historic facilities that haven't been meaningfully updated in decades. And like most construction projects, estimates have risen because of inflation, safety requirements, and unexpected issues like asbestos. Not because anyone is installing gold-plated conference rooms. Markets reacted to the news of the investigation because Fed independence is the backbone of stable mortgage interest rates. The Fed being neutral and not politically influenced is the backbone of stable mortgage interest rates. When investors believe that policy is driven by data instead of politics, long-term borrowing costs stay lower and more predictable. The bond market's wobble wasn't about Trump being in. The bond market's wobble wasn't about Powell being in trouble. It was about the risk that monetary policy could be pressured rather than principled. Nevertheless, pent-up demand is very real. There are a lot of nuances to how important the Federal Reserve's independence is, and most of Main Street wasn't following the investigation and its impact on interest rates in real time, and they definitely weren't watching it over the weekend. They saw Trump's announcement on Thursday, and they felt that the real estate tycoon was finally getting back to his roots and realizing home buyers want some relief. Mortgage applications jumped, and while I don't have nationwide data on that yet, it'll come in next week. I can tell you I personally had 12 loan apps come in one single day. Little old me. All weekend, I was dealing with clients, working on getting pre-approvals out, trying to compete in multiple offer situations, and fielding calls from brand new buyers who were finally ready to get their financing together and make a home purchase a reality this year. It was a really impactful reminder that interest rates don't have to crash in order for the competition to return. The perception of cheaper money is all that pent-up demand needs to flood in. The small improvement we saw in mortgage interest rates increased buyer confidence, pulled sideline buyers back into the market, and gave bidders the confidence to up their offers and win the deal. This is competition tightening in real time, my friends. And it further proves that 2026 will be a transition year. Rates will have little dips and then likely be checked, maybe by labor market resilience, inflation concerns, and with Trump in office, definitely by political uncertainty. But when they do hint at an improvement at easier borrowing conditions, activity will follow in a fast and furious way. That's why I'm convinced the winners this year won't be the dreamers in the what if or maybe someday phase. The winners will be the ones who find themselves prepared and ready to pounce. All this is not to go without noticing that the world is in fact on fire. And I promised you my theory, so here it is. The other headlines this week were heavy. Real estate doesn't exist outside that reality. Markets are made of human beings who feel what's happening in the world. I think we're nearing the end of having the privilege of pretending politics and daily life don't touch our decisions. What I saw this week wasn't a reaction to a $200 billion announcement. It was people reaching for something stable in an unstable moment. When buyers heard even a hint of relief on interest rates, they grabbed onto it and held on tight. Not because the math suddenly got perfect, it really didn't change all that much, but because hope felt practical again. The activity we saw wasn't about a sudden change in affordability, guys. It was about people wanting to move toward the concept of home, towards safety, ownership, and control of their corner of the world. Sometimes markets move on numbers, and sometimes they move because people are tired of waiting for the storm to pass.